Okay, guys, I guess we'll go ahead and kick it off here. Just get started, and I'm sure we'll have a few people that join us in progress, which is okay. I understand things happen; they might join late. Not a problem. This will be recorded for posterity, everyone. So we'll for sure we'll be live broadcasting this. I'm actually going to live broadcast this literally almost as soon as we're done. So if you're following me on LinkedIn, you'll have the video available to share for your audience. If you'd like to share your portion, for sure. Feel free to get a hold of me if you want the portion of your presentation. So, for example, Joel, if you want to slice up your piece of the puzzle, please do. By all means, this is intended to help not only us in terms of communicating, but also for the folks that were kind enough to join us and do their social media also. So, by all means, if you'd like raw video, please let me know. The content is a ongoing battle. We are all our own TV station now, and so we have to constantly produce content. So everyone, welcome. We're beginning to kick off our passive investing series. It's a 12-week series on different aspects of passive investing, primarily focused on real estate investing and what you can do to become a passive investor, what you need to look for, and the issues involved in picking out good sponsors. And so essentially we're going to talk about, underwriting, everywhere from underwriting and also wealth management issues in terms of, should you be using a self-directed IRA, EQRP, 401k, solo retirement funds, which we're excited about to share with you about today, because a lot of people don't know about that. In addition to what are some great asset classes and what are great opportunities in the real estate space. Before I continue, I'd like to introduce myself. My name is Douglas Dow. I'm the CIO of real estate and private equity firm Eagles Flight Equity Group. We focus on real estate and also small business entities, so we're investing in both spaces. Also joining us is John Rubino and David Rutherford. They are my co-hosts. John, if you want to tell us a little bit about yourself and what your background is.
Sure. So I've been in real estate for about 20 years. I served as a pilot in the Navy. I got some folks on here. Matt's on here. We served together in the Navy. A couple other folks I recognized, and some of our investors in the company here for our company, JID Investments. Was a naval aviator for 20 years and retired back in 2017 and started JID Investments back in 2013. As a private money real estate, private passive real estate investment company. I live here in the Washington, D.C. area with my wife and 4 kids. Been here since 2011. Love where we live because it gives us 3 of arguably the greatest markets in the area in D.C., Maryland, and Virginia. And it also gives us access to a lot of the markets we're kind of investing in with our business throughout the East Coast and the Southeast. I love talking with folks and sharing. I think that, our thought here, as Doug alluded to, is, talk as a group, learn as a group, and really look at different areas inside of passive real estate investment. Whereas if you're really interested in getting into it, some of the things to think about, we're not experts by any means, but we've been through a lot through our experiences, and we wanted to give that back. And we kind of thought, hey, let's do this as a multi-series event or multi-part event, just because there's so much information. So this will be a kind of running event in 7 parts, which we'll get to in a few. But I love real estate, been around it. It's exciting. You meet great people. And I'm really excited that everyone's here. I want to welcome Dan Lyon and Mike Torrey too as well today. They're going to speak on behalf of attorneys and for registered investment advisors. So they'll have a speaking part today. And also just reiterate, Douglas welcoming Joel to the group as well. So thank you guys. And, we want this to be interactive. So please, if you've got questions, maybe throw those in the chat. We'll get to those either during the discussion or at the end. But again, we want this to be hands-on, interactive, ask questions. I'll be the first one to say sometimes I ask stupid questions, so don't feel any question is stupid. Just ask it, because there's other people that may, including myself, may want to know what you have to say. So thanks again, and I'll throw it over to Dave. I'm the COO, Chief Operating Officer, JD, the founder, and we've got about 30 projects right now with a profile of about $40 million worth of investments, and we're growing. So I'll throw it over to Dave to introduce himself as our third speaking partner for this series.
Yeah, thanks, John. Good afternoon, everyone. Dave Rutherford. I recognize a lot of names here from, emails and correspondence. So it's really nice to be able to put some faces with names as well. Little bit about me. I had a 22-year career within the U.S. intelligence community, 12 years active duty military, another 10 as a civilian. A couple of years ago, my wife retired after a 20-year active duty Air Force career, and we both decided to leave the government. So went back to school, got a little more education, and was very fortunate to be recruited and found by John and JID Investments. That was just over 2 years ago. So absolutely loving this world, loving this new business venture. I've learned a tremendous amount from John. And kind of along that same note, one of the things that John and I have really talked about a lot over the last year and a half is education. Just being able to put out the word on passive real estate investing and just kind of providing some general education to folks. Because when most folks think real estate investing, they think, buying houses, fix and flips, rental properties, things like that. And the idea behind JID is that, as an investor, you don't actively manage anything. We're a passive real estate investment company. We do all of the heavy lifting, the due diligence, on your behalf, and we always seek to provide the highest possible returns for our investors. So yeah, we're really excited to be doing this 7-part series. As Doug alluded to earlier, today's session is going to be talking about how to put together your team. We're going to cover other aspects of passive real estate investing, capital stack, due diligence, waterfalls, you name it. But we'll kind of get into that a little later on down the road. But it's great to see all of you, great to meet all of you, and I look forward to the next, 7 or 8 sessions.
Thanks, Dave. Doug, I think if you want to go ahead and give me the control there, I'll go ahead.
Should have co-host rights there, John. You should be able to
okay.
Share
Yeah.
nicely there.
Awesome. Very good. Thank you, sir.
Sure.
And here we go. So we'll kick it off with some slides. Again, these slides are just kind of for instructional purposes, but at the same time, we'll go over and use them primarily throughout the presentation. Again, if you have questions, something you want to jump in on while we're going through this stuff, please feel free. And let's get going. So just a quick disclaimer. Obviously, there's going to be a lot of information we shared today. Some of that information obviously is stuff that you want to just confirm or talk to your trusted agent about. We'll talk about trusted agents throughout today, but just make sure obviously when we're going through some of the stuff, if you have questions or if you want to go through anything in particular, reach out to us. But there are other people that are going to sit in certain roles that are probably better served. So the information here, again, just to share, educate, but at the same time, trust but verify. And that's kind of the big takeaway from our disclaimer. Okay, and you got a chance to meet us and team. We've got vast experience and we've been working on this for a few months. So we're glad to be together and be able to provide, kind of from where we sit and what we've experienced, some of this information. And hopefully our insights and our sharing is beneficial and valuable. And thanks again for joining us. So just some quick precursors here. Everybody hears this term, passive real estate investment, syndication, crowdfunding. So I guess the big thing is, we talked about what's the purpose of the webinar, but what is passive real estate investing? And really passive real estate investing simply is just investing in real estate without substantial hands-on effort or active participation from your part as an investor. There's typically 2 methods of passive real estate investing, which we'll talk about in a bit. But what differs between passive and typically what we call active investing is, Dave alluded to a bit, passive is more where you're going to be part of a partnership, where you're going to be part of an investment, where you're not directly actively managing the project. You're not directly involved in the asset, where you're managing construction. You're not overseeing operations day to day, dealing with tenants, having to deal with things like bank debt and recourse loans, which basically means you're personally guaranteeing these multi-million-dollar loans. You're purely sitting in a seat where you have your full-time job, or you own a business, or you're retired and enjoying yourself, but you have the opportunity to be involved in these different types of projects more kind of as an outside looking in, and your money's being kind of managed and or kind of operated with through these sponsors that you're going to be investing with on their investments. So again, less hands-on. You can start getting a little more active if you want in turnkey, which is basically, hey, I buy a building, I've got a property management team, and I've got tenants. But in that scenario, you have ownership of that property. You're actually taking ownership, physical ownership of that property. But it is considered passive because you're not, again, they're day to day. You have a property management company or you have a group that's overseeing that. And then obviously active is you are running the project, you own the property, you're out putting together the money for the property, you're overseeing the general contractors, you're doing all the day-to-day operations. So that's kind of the big difference between the two. The strategy for passive really is someone who wants to just collect rental income, long-term capital gains, profits, and kind of sit in a more passive role.
And John, quick question
ahead,
for the
Doug,
folks at
please.
home, for the distinction, why would we do this instead of a REIT?
Yeah, and that's a great question. We'll get into this a little bit more, but passive real estate investing, there's different ways to do it. A REIT, which is a real estate investment trust, is more on the line of what's available to the open public. If you wanted to go out and you wanted to buy a REIT from your certified financial advisor through Charles Schwab, or you wanted to do it yourself on the open market, a REIT's a little more public, Doug, as opposed to something like a syndication or a private placement offering, which is a little more private. And there's some stipulations there we'll talk about, but that's really the biggest difference between the two. Anything to add, Doug or Dave, or I'll open it to Mike. And Mike Torrey's our registered investment advisor. Mike, anything that you want to comment on from where you sit, with regards to REITs or Delaware statutory trusts or 1031s?
Yeah, I think the biggest thing is, the choice of entity is really up to the sponsor company. There are privately held REITs as well. So it really depends upon how they elect to handle the taxation side of everything, as well as cash flow, payments to investors, things of that nature. So you've got your publicly traded REITs, of course, like you mentioned, that you can check the ticker symbol. You can follow it on any of the financial websites out there, Yahoo Money, Yahoo Finance, CNN Money, places like that. So, but no, great comparison.
Yeah, and Mike, I think you would agree, like a 1031 is a little bit different than, let's say, an opportunity zone, which are two different types of investments where you can use tax deferred gains and you could kind of get creative on the tax strategy side. But using those two specifically as an example, a 1031 is really more on the active side, where you buy something, you have it sit for a while, you get a significant gain from the disposition or sale, and then you want to take that entire investment on that project or property and the profits to roll it into something light, so you don't get taxed on that when you liquidate. Whereas with like an opportunity zone, it's more passive, right? It's still a tax deferred opportunity where you're taking out profits from your gain and you're reinvesting that into another opportunity. But again, it's passive. So those are just some examples of active versus passive. Another one would be, hey, I want to go buy a house. I'm going to renovate it, going to fix it up, going to sell it or hold on to it. Again, you're active. So hopefully that makes sense.
John, I do have a great question posed by Joel. REITs are publicly traded and over the counter and therefore highly regulated, therefore available to unaccredited investors. A fair number of private placements are accredited investor only, and I'm sure we're going to get into the weeds on what that means. But that's not to say that they're only available to only accredited investor. There is a class called 506B, as in boy, that does allow non-accredited investors to be involved. And also there's crowdfunding also. So those are more of a private, but not accredited vehicle as well. So there are a ton of options out there.
Yeah, and Dave, why don't you just real quickly give everyone kind of the difference between what an accredited investor is, and then from a private placement standpoint, when we have opportunities where it's going to be through what's called a private placement memorandum, or like Doug alluded to, a 506B or 506C investment. Why don't you give everyone maybe just a quick rundown on that?
Sure, yeah, it's a pretty simple distinction. Accredited investor is anyone with $1 million or more of net worth, excluding your primary residence. Or an accredited investor can be based on income status, whereas I believe it's as a single person, you need to earn an income of $200,000 per year for single, and then for, I believe it's $300,000 for married couples, verifiable through bank statements, W-2s, things like that. And really, the benefit of being an accredited investor is there's less regulation, and essentially you have more freedom to the type of investments that are available to you. The non-accredited investor, also called a qualified or sophisticated investor, you may hear those terms as well. That's simply anyone who does not meet the accredited investor status. And as Doug mentioned, with 506C opportunities, those are generally only open to accredited investors, where 506B opportunities are open to both accredited and sophisticated investors, but the number of sophisticated investors allowed to invest on a 506B is limited. I want to say it's no more than 35. So that's just a quick rundown on accredited versus non-accredited, and kind of the regulation that allows people to invest in different opportunities.
Yeah, great points, Dave. And so, just to reiterate, to be an accredited investor on the individual side, yeah, Dave mentioned 200,000 if you file single, or 300 if you file jointly over the last 2 cycles. So if you take your tax returns and you look at your adjusted gross income, that number at the top, the AGI, if that number is 200,000 or more over the last 2 years, and you file single, then you're an accredited investor. If you're married and you can now utilize resources associated with your spouse, that's 300,000 over the last 2 years. That's the income on the individual. You can also, and this is an or, qualify at $1 million or more of net worth, not including your primary resident or your insurance death benefits. So if you have a business, you have cars, you have hard assets, soft assets, investments, those go towards that $1 million. If you're an entity, Mike alluded to an entity, you could be a trust, Doug talked about, and Joel will talk about later, self-directed IRA. You're an LLC. There's different methods you can use to invest as an entity. There's different qualifications for that on the accredited investor. Now, the SEC is very, very, very deliberate and gives good guidance on that. But from a non-accredited investor standpoint, they don't. So you have to use judgment there if you're going to invest in an investment opportunity. It's a private placement. So you would only be allowed to invest in 506Bs, and 506Bs are not always, well, they're not supposed to be solicited. It's actually against the law. So you wouldn't be able to go out on an open forum like Facebook or LinkedIn or Twitter to find a 506B. You may need to get someone like Mike Torrey, or you may need to talk to your certified financial advisor to see if you qualify to find some of those 506Bs. So great description, Mike. I'm sorry, Dave. All right, let's keep going. And please pause if we want to talk more. So indirect versus direct, we talked a little bit about that. Indirect passive is probably like REITs, something that's a little more publicly traded. If you have a fund that you're investing in, a larger fund that's offered through a public institution. Whereas direct, again, we talked about that a little bit, passive would be a private placement. You're actually going to be part of a partnership, or you're going to be part of an entity that's partnered into the project. So a little more hands-on, but a little bit more than the indirect, but you're still kind of sitting back and you're overseeing. Now you can invest directly into a property as a passive investor, or you can also invest directly into a fund. So it just depends on what your appetite is. Sometimes funds offer more diversification, multiple properties or multiple investments inside the fund, whereas a direct investment into an entity for a property, we call it an SPV, a single purpose vehicle. That's kind of investing directly into a property. So I'm going to keep pressing. Do you guys have anything on these two? And I'll keep going. If there's more questions, we can take a pause.
Can I ask a quick question for
Yeah,
you,
go
John?
ahead, Matt.
Hey, so most of the projects that you guys are running, are they multiple properties, or are they single unit kind of investment opportunities for the funds?
Yeah, so the majority amount are single purpose vehicles. So we set up a private placement specifically for a specific project. We have taken up to only 2 projects at one time and put them into one fund, only because it's in the same market or with the same sponsor, the same timeline, or similar returns. But most of the time we're doing single purpose vehicles. The only other fund that we have that's actually a little bit broader is we have an opportunity zone fund. Those are really focused on markets. So we have an opportunity zone for Ohio, one for DC, Maryland, Virginia. That's kind of the larger gist of it, but most of them are single purpose vehicles.
Yeah, and if I
So
could
the-
add to that, John, this is a really great point too. As a passive investor, you have to have a lot more confidence in the sponsor when it comes to a fund context, because they're making the choices on properties and details about their property. Whereas with an SPV, which is where most syndicators operate, I would say, as a general rule, until they get a large track record, you get a chance to say this particular fact pattern, I get the economics of a particular deal, versus like the opportunity zone, they have a little bit more discretion in terms of the fund manager. So you have to really have a lot more confidence in the fund manager, which they should in John's case, by the way, for the record. I may be a little biased in getting to know John, but for sure they have a great track record themselves. And as a prime example of where they have the wherewithal and the experience to run an open-ended fund. So you have a lot more faith when you're investing in a fund context versus a single purpose vehicle.
Yeah, Matt, did you have something else you wanted to ask?
Yeah, just a quick question. So just to clarify, for example, on this Charleston opportunity that you guys have, that is multiple units within that property, right?
Yeah, but the investment is a single purpose vehicle. So the partnership
Okay.
set up for one project, one investment,
Got it.
which is that Charleston project. Yeah.
Got it. Okay,
So-
that helps. Thanks.
No worries, my pleasure. So let's talk a little bit about the benefits and risk. Obviously the benefits is that with a passive investing, it could be a great way to make some extra money. It's a good way to diversify in your investment portfolio. If you got stocks and 401ks and IRAs, it's a great way to get into some alternative investments. But like any investment, it's not risk-free. So some of the benefits, it's less money is required. One of the things that you'll see is you'll have a 25, 50,000 minimum, whereas the total combined raise, let's say for a syndication or for a private placement, could be $3 million or $5 million. So you as an individual investor can come in for 25 to 50 and be part of the $3 to $5 million raise, which would be, maybe something you wouldn't be comfortable trying to do on your own. Even if you had that capital, you may want to just diversify a bit. So it gives you diversification. And if you were investing actively, you would be having to invest the entire amount, which is obviously challenging. You don't have to have a lot of deep knowledge. And I don't mean to say that, you just jump in and throw your money at anything, but it's a lot less as far as knowledge of things that you have to know about when it comes to, like, do we put up concrete framing or wood framing on this project? Or, does the market demand granite countertops or marble countertops? Your knowledge of this, and we're going to get into this as we go through each part, you don't have to be a guru or a subject matter expert. You'll have enough to arm yourself, we believe, after you go through this, but there's also going to be tools that you can learn and you can read about and grow your own list and strategy, but you don't have to have a ton of knowledge on how to do this. It's not extensive. You don't have to get a degree for this. And it's a great way, again, to make extra capital. Definitely better liquidity events. Not as liquid as a stock where if you say, hey, it's down 2 points, I'm going to sell today, or hey, it's down, I'm going to invest or pull out. But you still get things like monthly cash flow potentially depending on the type of asset it is, or quarterly or yearly, or you get a lot of tax benefits through depreciation and deferred gains. There's different things that this presents that will allow you the opportunity to have capital available and get a nice return on your investment. And it's less work. We talked about that. You don't have to go and pick up all the material, and you don't have to go out and meet the contractor. You don't have to negotiate the guaranteed minimum price contract. So there's a lot of benefits there. Some of the risks, it's not as profitable, right? I mean, the sponsors, we'll talk about these guys and the developers, they typically make a really nice, promote or a profit after they give back what they're offering through their waterfall, again, which we'll talk about later. But it's not as profitable if you were going to be an active owner. So basically more work, more profit, but at the same time, it still offers you great profits. A hands-off approach, like we said, we've got an investor portal for our business. A lot of companies do. And just like you would if you had Charles Schwab and you were looking at your investments, on a Saturday morning with coffee and your pajamas, you can go through and look at your investments through passive investing. And then you can go to work on Monday, run your business, and know that that investment is still working for you while you're still there. Anything else that you guys would want to add? The only thing I was going to say, Alice, is the market fluctuations is another thing. When you manage your own property, there's a lot of risk, like vacancies. There's going to be tenants that that necessarily may not pay on time, or you have to offer concessions to. You may be kind of hit directly in markets that are not performing as well. So with diversification through passive real estate investment, you can kind of mitigate or kind of avoid a lot of those risks. So guys, anything else to add on benefits and risks before we go to whether it's worth it or not?
Hey, John, I've got one thing.
Yeah,
I know when I talk to people, the liquidity side of it it can be a big risk. If people go in and don't fully understand, what the liquidity issues could be, if they're in a situation down the road, is there a holding period? If they need to get to their money, is there a certain period of time where there may be a window open where they can get a portion of their liquidity back? Some sponsors allow that. It just depends.
Yeah.
Obviously, there's no secondary market, so you can't take your shares and sell them to somebody else. They really need to read that contract, read that agreement, and understand it.
Yeah. And I think Charlie had a good question about interest rates, and we're seeing that now. We were in a pretty low interest rate environment a couple of years for a while, and then just recently we've seen these crazy interest rates go up. It just depends on where you are and where the project is. If you're getting ready to underwrite a project that has a higher interest rate, you just got to take into consideration how that's going to eat into cash flow, how that may impact distributions, and whether or not your debt service coverage ratio, which is something we could talk about, is high enough to be able to pay off the mortgage each month and still be able to produce enough cash flow just to pay you as an investor. So that's definitely something you want to put on your list is, when you're looking at deals, what's the interest rate? If a company's getting a 6% interest rate versus an 8% interest rate, that's going to have an impact on your cash flow. So that's something definitely you want to look at. So again, the question is passive real estate investing worth it? And that's really that's not a one size fit all. That's something you got to think about. If you've got kids and the kids are going to be college age one day or going to be nearing college age, and you want to put more money into a 529, or if you have extra capital you want to put into your IRAs, if it's a Roth and you can put in your max contribution, that's obviously, something you want to think about. And you want to sit down and look at your, opportunity costs on one investment versus another. But like what we say to our investors for JD is, if you've got everything maxed out and you're putting money in the bank every month or every year, and it's just sitting there, inflation, the last I checked, is at 6.41%. So you're basically giving the government not only an interest-free loan, but you're giving them you're getting interest. I shouldn't say that. You're basically losing value on your money at 6.41% for just sitting in the account there. Yeah, you're going to get some interest from the bank, but it could be working for you elsewhere outside of just sitting in the bank if you have the desire. So it's really a question you've got to ask yourself, and then also, do you want to be more active? If you have more time on your hands and you're in a good market and you can sit down and do the research and you can identify property in your vicinity that has opportunity for active investment, go for it. And you can do that. You can definitely listen to podcasts and you can get information on how to do that. But from a passive standpoint, if I had $500,000 and I could park $50,000 of that in each different types of investments that are passive, that to me makes sense, because if I'm getting, let's say, 8% a year on that $500,000, that's $40K a year, let's say 4,000 on each of those projects, I've got nice diversification. I got nice cash flow coming in, and that's a nice check that I'm willing to go get every month from the mailbox. So.
And
um,
John, if I could
yep.
add something about the interest rate thing, I forgot to mention, I need to make sure and add color. Looks like the Fed has maybe 2 more raises in their chamber right now, maybe 3, depending on how things go. This is something I'm in the weeds on every day, day in, day out, frankly. And so it looks like 2 more raises. So what I would say is we're toward the top of the interest rate hike. So most of the effect is probably already priced into the market. So this is actually, I feel, a time to get really aggressive, because all the pain is basically working through the system in terms of real estate. So most of the impact from interest rate is already being felt. And so we're really, really bullish right now. And that's what I would say generally how we're thinking anyway, and for what it's worth.
Yeah, and that's a great point. One of the things also you got to look at, is Charlie mentioned, there are higher interest rates, but a lot of loans are going to be called this year, meaning that there's going to be a lot of debt that is going to have to be paid back. And if developers and sponsors aren't hitting their numbers, and they've got this pressure to get out of these deals, they're going to have to liquidate that property and to get that money out of there. And if there's not enough profit margin, there could be a lot of risk there. But on the other side of the coin, there's a lot of opportunity, because people could come in and buy a property at a very significant, reduced value, and get in and have the opportunity to come in at a lower baseline, a lower valuation, for knowing that property has the potential. So maybe that higher interest rate's okay, because you're willing to get that price at a much less cost. The bank knows that too. And then you've got a refinance opportunity when the rates hopefully come down, let's say next year in 2025. So you got an opportunity to refinance out at a lower rate and get some cash flow, get a nice lump sum check back, either in the form of your preferred return or your investment, pending your waterfall. So that's a good point. And I think people need to be aware of that. So you see on the screen, here's the 7 parts. We're gonna start today with your team. And next part we'll go through how to look at sponsors. What are some of the things you need to think about? What I would suggest is 2 things. One, take notes throughout this if you'd like. We're going to have a lot of different resources to share. If you want to schedule a call with Doug, myself, or Dave, or Mike, or Joel, or Dan, I would suggest so, because we'll be able to spend a little more time with you, share some of these resources, and help you as you go through this journey. The third part, we'll look at the location, which, right next to the sponsor is probably the most important thing. Is, a lot of people like to invest where they live. A lot of people don't mind to invest outside of where they live. And that's another benefit of passive investment. You don't have to be working in Virginia and have to run down to Florida to manage your rental property. If you want to do that, great. But if not, you don't have to do that. But you still want to know about the markets. And that's a very important. We'll talk more about that in part 3. Types of real estate projects, you have the asset classes, different asset classes. You got storage, you got student housing, you got multifamily, you got build to rent, you've got opportunity zone, you've got all these different assisted living, you got all these different types of asset classes. So, you want to look at this and say, what's best for me based on, after I know the sponsor and I know the location, what do I want to invest in? I like storage because there's no tenant there. There's just property. There's just valuable sitting in there. So, you have to worry about having to appease a tenant all the time, or, it might be something you like better. Student housing. I live by the University of Alabama or South Carolina. I want to get into student housing because I live right by the universities. The capital stack will be an important one, because it'll show you how we put together the money for a project. How does the bank come in? What do they usually require? What's after the bank? How do those returns work? So that'll be a good series we talk about, or a part we talk about. Part 6 is really important. I would suggest you come out to that one. Due diligence, and again, how do you pull the due diligence apart to make sure that again, you're walking into an investment you're comfortable with? What are the questions that you want to ask your sponsors, or you want to ask the folks you're investing your money with? And I'm sure Mike gets this all the time. We do get this a lot, and I'm sure certified financial planners get this all the time. You get folks that say, I'm sorry I might be asking this question. Don't feel sorry, it's your money. You have every right to ask every question. You have every right to ask for the information. And to be honest with you, if you get a sponsor or a group you invest with that says to you, oh, I don't like to share that, that might be a red flag, and you may need to pull the thread on that a bit. So that'll be important. And then the last one is going to be the waterfall, which is fun. That's how you're going to get paid. That's how you're going to make your profits as a passive investor. That's how you're going to get your money back. Anybody could tell you, hey, I'm going to make you these 30%, 40% returns. But my first question is, how do you protect my money? And I want to hear multiple answers, not just one answer, because if that door's locked, how do I get the other doors to open to make sure I get my money back? So guys, before we get into your team, anything you want to touch on here and for this or future parts?
Yeah, John, I do want to hop in on the transparency issue. That's, for me, one part of the reason why I do what we do is I see in the marketplace, especially with Wall Street, very, very opaque fee structures and very opaque calculus in terms of what we're getting from Wall Street. And this is also true with different sponsors. You may have different levels of transparency. So I think that's a fair thing to ask for. When you think of it, you are a partner in their business. So where I come from, partner means I see everything. And so the unwillingness to share information and data is also, I think, John, you put a finger on it, just a huge red flag. And I really wanted to also co-sign that statement.
Thanks.
And
Appreciate that,
hey, John, this is Dan, and I might as well jump in here as well, because obviously there are legal ramifications related to everything that you're talking about. We already talked about public versus private offerings being subject to the Securities Act, whether or not you're trying to get a Regulation D exemption, which one you're trying to get. Well, from the perspective of those exemptions and being the sponsor or the person who's really running this opportunity, the disclosure is extremely important. I don't care what exemption you're looking at. If you're not dealing with an accredited investor, you're going to have to provide a ton of information. You're going to have to provide almost everything you put in a disclosure statement. And I'm not a securities attorney. That isn't specifically what I do. But we have to look at these exemptions and specifically in this space with what you guys are doing. And that's what I really like about this presentation. This is what I really like about what John has given me in the past. And I know that you guys are really, really good at getting data to your investors. The more data, the better. It's in the best interest of the sponsor in addition to the investor. So, I applaud you all for that. It's really important, and it's good legal practice as well.